Dear viewers, welcome to this episode of Expert Speaks. Market has been a place of action. Markets have been rising. It's just not rising in India, it's rising in US, it's rising in Japan, it is rising in Eurozone. To know about what exactly is driving the markets up, are there points of concern? Is a bubble is forming? What's happening with the small and mid-cap stocks? I spoke to the expert of the week, Mr. Sridatta Bhandwaldar, head of equities of Canara Robecco mutual funds in this episode. Very interesting points he has shared with us. Please stay till the end of this video. There is a lot of guidance for the investor in you. This is NRI Money Clinic for you, and I am Dr. Chandrakant, but your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
The expert of the week is Head of Equities, Canara Robecco Mutual Fund, Mr. Sridatta Bhandwaldar. Mr. Sridatta has a rich experience of over 16 years. He has been working with Canara Robecco Mutual Fund since 2016. Prior to that, he has worked with Motilal Oswal Securities, SBI Pension, Heritage Capital, and MF Global. He looks after an equity AUM in excess of $5 billion worth of equity AUM. Let's listen to him, what he has to say on what exactly is happening in the market. Let's listen to him. Welcome to this podcast, Mr. Sridatta Bhandwaldar. I'm excited to talk to you. Your voice matters in the industry, and we have seen the funds that you have managed performing very well. I have few questions for you on behalf of my audience. The first question is, markets are on the rise. We have seen Indian markets taking lifetime highs a few months before, and we saw the European markets climbing to the lifetime highs. US markets have moved to the lifetime highs. Where are we heading? Is it the peak of the rally? Is there more steam? What do you see as head of equities in Canara Robecco Mutual Fund? How do you see the markets?
First of all, thanks, Mr. Bhatt, for having us on the show. I'm equally delighted to be on the show. When you actually think about the market, it's very, very simple in our mind. Of course, there are complexities which are related to interest rate environment, or there are complexities related to geopolitics. But we'll first keep it relatively simple in terms of what is the basic fundamentals of equities. And then we'll add the layers of these complexities to the equation. So first, let us start with the Indian market. When you think about how the Indian market has been behaving, yes, the market is at new peak, but so are the profits. And the only thing, if I may actually summarize my entire career, that I have learned is that market is slave of earnings, and market is just a function of earnings. So if the earnings have virtually more than doubled in last 4 years, so has been the market. Is market expensive? Probably the large caps are not expensive. Mid cap, small cap, as you go, there is a little bit of froth. But we are actually more focused, as I said, on earnings part of the equation. As long as the earnings keep playing out, you don't have to worry so much. And so when you look at the Indian context today, if you step back and think about it, for last 4 years, you had almost more than doubling of the earnings. If you think about last 1 year, and particularly financial year 24, we have about 25% earnings growth. And that's also reflecting in the way market is actually reacting to those earnings. Having said this, one has to be a little more cautious as going into financial year 25, because we see that financial year 25 will have a little bit of earnings moderation. No earnings collapse, but clearly more earnings moderation, and that is likely to happen for financial year 25. And it's just a function of a very, very simple statistical phenomenon that in financial year 24, you had a lot of margin expansion benefits that flow into the earnings. In financial year 25, those will be missing. So your top line is what predominantly will flow into the earnings growth. So that's the first and very, very core argument, that how the earnings are panning out, that will decide how the market is likely to behave. Now, if you have to add one more layer to it, typically when do we get this kind of earnings? Like what I said, and most of us actually don't even appreciate that basically in 4 years earnings are doubled, or BSE 500 profits are doubled. When do you get these kind of cycles? You get this kind of cycles typically when the balance sheets are reflating in the economy. And on top of that, if you have government policies which are supportive both for the investment part of the economy as well as in general for other parts of the economies. So when you actually look back between 15 to 20, we struggled because the balance sheets were in a mode of deleveraging. Corporates were deleveraging. Banks were actually suffering with NPA. Households were sitting on the previous cycle's housing loans. As that has cleaned up, that's where our earnings cycle has started. So typically, from a top-down perspective, my assessment is you get earnings expansions during the balance sheet expansion cycles of the economy. And that's where we are. That's the additional layer, which is not top bottom up, but which is top down. So when you combine both these, top down, where the balance sheets are headed, where the government policies are, in which direction government policies are moving, when you look at even the government's direct fiscal spending, where it is happening, which is predominantly happening on the investment part of the economy, not on the consumption part of the economy. This is what exactly reflects in the basically earnings part of the economy, where earnings have doubled. Having said this, when you look at, like what you rightly said, when you look at the market, which is at a near-term top, market, in our view, is likely to take a little bit of pause in terms of consolidation, assess incrementally whether the earnings growth keeps flowing on or not. And that's where we feel that financially 25, 26 are unlikely to be, while they will still be very, very healthy. 15% probably earnings growth. Consensus is building in 15% earnings growth. We are also largely around that. But that will look like a little bit of moderation from financial year 24. So that's how we're looking at the Indian market. So clearly the view is probably top 150 companies is where you don't have any expectations built up. The margin of safety is far higher in terms of valuation vis-a-vis as you keep going down the market cap curve. Having said this, how do we see 2-3 years from here? We still see that you are in a business cycle, you are in a credit growth cycle, you are in an earnings cycle. So you'll still have 13 to 15% earnings CAGR for next 3 years. The government policies are aligned to actually invest back in economy. When you actually club all those, and on top of that, after a very, very long period in time, you have basically real estate cycle in the economy, which is probably has the largest multiplier impact in terms of what it can do to economy. So when you club all these things, are we worried from 3-year perspective that we'll get 15% earnings growth or not? My answer will be we are not worried about that. And that's where your rollover returns will continue. So any investor who has 2-3 year view, who's looking at it as a wealth creation mode rather than actually speculation mode, I think for him, there is nothing to worry. Consolidation, intermittent corrections is always a healthy thing, and which might happen in part of the market, in my personal view, during this year at some point in time. So that's how we're looking at Indian market. When it comes to the global piece, the global piece equation has been more top down. That we did not experience. They experienced the kind of interest rate increases that we have not experienced. Our entire interest rate cycle on the upside, the last interest rate hikes have been about 200 basis points. On a 550 basis point. In fact, only 100 basis point, I guess, at repo level. When you actually look at the developed market, they have had actually increases anywhere between 150 to 100 to 400 basis. Now, with this 300-400 basis point interest rate increases in a short span of 1 year, most of the people were expecting that there will be serious recessions, there will be serious unemployment creation, there will be serious dampener to the incremental growth. That was the view that predominantly existed right through the CY22 and part of CY23. As people realizing lately, more so in CY23, that it's not turning out to be as bad as most of us thought in terms of how much these interest rates are likely to damage the economy. And it is not damaging as much, at least as of now, whatever data you see, it is not damaging the households or businesses as much as it was expected earlier. And that's where you are seeing at the margin, earnings are being resilient, the growth being resilient, or upgrades at the margin, because you've just gone to the other extreme in terms of expectations. And that's where you're seeing basically markets doing well. Having said that, it is a very, very different market in particularly US, where probably 8-10 companies are contributing to almost 2/3 or more than that market appreciation over last 1 year. So it is predominantly concentrated in few stocks and not as broad-based as we are, which also means that the investors are still worried that the lag impact of the interest rates will happen on economy. But let us see how it plays out. So I think that's what on the domestic side and global piece in terms of how we're looking at the equity market.
For any bull market to exhibit itself, there are 3 components which are, one is growth, what you said that growth is happening right now. The second is sentiments. It's obvious, it is visible. The sentiments are favorable to the market. But the real driving force, the fuel of any market is the liquidity or the funds flowing into the market. From an Indian market perspective, where do you see the funds are coming from? Are the FIs are pushing the money here? Is it the domestic institutional investors who are pouring in the money? Or is it the massive retail participation which is driving up the market? How do you see the fund flow? Do you have any statistics for here?
It's an interesting and a little different market than the normalized market. And there is no exact statistics around it, but there's clearly a lot more participation from retail, PMSs, AIF, a lot of institution-based HNIs, which is not necessarily as institutionalized as your mutual funds or insurance or larger FIs, long-only FIs are. And to that extent, you are seeing the dislocations in the market. Having said that, when you look at the flows, they are predominantly domestic. So flows have been coming from all quarters. Mutual funds are receiving flows every month, about 15,000-20,000 crore rupees. The insurance companies are receiving flows because government has allowed some of the the PFs and other guys to actually put in up to 5 to 15% of money in the indices or in the market. Part of that money is coming in. There is NPS money that is coming in. And then on top of that, you have retail HNIs. And so it's predominantly domestic money, because when you look at FIs, while calendar year 23 second half was generally very strong for FI inflows, if you look at net calendar year 22 and 23, they haven't invested anything in India. Calendar year 22 was about $16-17 billion, if my memory serves me right, negative. And calendar year 23 has been positive, about $20-21 billion. So it's net $2-3 billion of positive inflow over last 2 calendar years. That only tells you that not that they are negative, but it is just that for a lot of those investors, valuations of the Indian market generally becomes a difficulty to allocate incremental capital. Because there is a set of long-only guys who have been present in India for last 5, 7, 10 years, 15 years, and which are large global institutions. And there are enough number of large institutions which are not present. Now, for the new guys to keep allocating, generally the concern that I have seen is that we like India, we like the earnings story, we like the growth story, we know the longevity. But the challenge is in terms of valuation and what it implies in terms of the return expected. Also, for a lot of large global guys, still Indian market is less liquid. I mean, for most of the global large pension funds or insurance companies or asset managers, if you think about India, probably how many companies they can invest in India in a sizable manner, probably not more than 20, 30 companies, because we just don't have size in terms of market capitalization vis-a-vis the sizes of a lot of these companies, a lot of these asset managers. So that's how the flows are stacked up.
One question that comes to my mind is we are passing through a phase where we are heading into a general elections, right? And is there a phenomena that during every elections, the general election, is it an election rally which is happening here, or it has nothing to do with the elections as such?
So around elections, there are generally rotations. So when you look at last 5-6 elections, yes, around every election, and typically pre-election, there has been a rally of anywhere between 5% to 12-13%. Pre-election, there is always this expectation that new government will come in and will do something new. This time around, of course, there was a continuity. So we have not only pre-election rally, we have been rallying from last Feb, correct? It is just that probably the last leg after the December or probably November, December was very ferocious, because with the existing political establishment, meaning the 3-4 states out of 5 states, it got basically the probability of the same establishment continuing has gone up, and that's where probably market has rallied more. But I would still put it, whether election, not election, people fall back to the earnings growth, and the earnings growth for financial year 24 for first 3 quarters has been extremely strong. And part of it, as I earlier at the start also alluded to, is also because of the margin tailwinds that were in existence in financial year 24, which will be far lower in financial year 25. Not that it will go away, but financial 25 will be more 15% year earnings growth vis-a-vis 25% earnings growth that financial year 24 was, So that's how we tend to look at it. And on top of that, you have this layer of liquidity, which is of course creating different sets of outcomes as you go down the broader market. And just to put it in example, and I'll not take the name, but a large cap name, the dispersions in the multiples is always limited, irrespective of earnings deviations. For example, a particular large cap, say IT company or FMCG company or any large cap company, say industrial company, when its earnings growth moves from 15% to 25, at max its multiple moves from say 20 to 30. It doesn't move between a range of 10 to 30. Typically, as you go down the market cap curves, when the earnings cycle comes, that marginal liquidity creates huge dispersion in the multiples. For example, a small cap with the same earnings delta will experience a far more multiple re-rating. And that's what you are seeing today in market, because liquidity is flowing in. There is a marginal liquidity which is creating that dislocation. But that is the nature of market. So it will adjust gradually as you go through the earnings cycle. As the earnings moderate, these multiples also actually keep moderating.
Mr. Sridatta, public memory is always short-lived. Who have been in the market for a long time, there are a lot of people who are new to the market. One observation to make here is people have forgotten 2007 and 8. People have also forgotten 2018, what happened with the small and mid caps. Recently, we saw newspapers reporting that SEBI has advised caution with mid and small caps and asked the mutual fund houses to highlight the risk which will come with this. I also saw yesterday a direction from AMFi given to the mutual funds to look into this matter. What is causing this regulatory actions or awareness programs, whatever you can call it? Is there a bubble which is building in mid and small caps? What is the message that you have for the investing general public?
Sure. So I think regulatory doing the things which is right, as you said rightly. When people see disproportionate return, there is typically tendency to actually chase those categories, and those categories have a particular ability to take liquidity. For example, in top 100 companies, you can put in a lot more liquidity and it can get absorbed as you go down the market cap curve. It can create dislocations in near term, and regulator rightly so, in the interest of the investor, is actually in a way telling the asset managers to actually disclose all the details, because in this kind of environment there is always you run a risk where the portfolios might get just too illiquid, portfolios might just get too risky, the outcomes of which you will only see 1 year, 2 year down the line whenever the risk plays out. As of now, there is no risk, so nobody is seeing those. So in a way, a regulator is preempting, not that there is anything wrong, but regulator is just being cautious in terms of at least the investor should be aware of what product he's getting into, and within the same product categories, whether it is small cap or mid cap, how different funds are positioned in terms of their liquidity, asset liabilities, concentration of securities, how much they own in a particular security, all those parameters which in a particularly small cap and mid cap portfolios investors should generally ask. But since Indian market is far more retail market, people don't ask these questions. They predominantly focus on only one thing, which is the returns. And those returns can evaporate fast in a category like small cap or mid cap when the actually earnings don't pan out properly or some risk event plays out. And given the pace at which the market has moved over last probably 9 months in terms of, or 12 months in terms of particularly the broader market, regulator rightly is actually pointing out that you start at least disclosing these things and start taking the measures which will ensure that there is no asset liability challenge that the AMCs have, or at least on the other hand, the investor is aware that okay, this is what he's getting into. Also, in a way, regulator is actually cautioning everybody, including the retail investors and AMCs. Is fraud building, not building? It's only typically these things you only come to know in hindsight. The only statistical data that you have to tell that probably the broader market is expensive, and that's where I said probably 3 times in the last 30 minutes that it is expensive, is because it's trading at probably 1 standard deviation or 1.5 standard deviation higher than the valuation that they themselves are traded in the past, or they are trading at anywhere between 15 to 25% premium to large cap. With this kind of premiums, generally don't sustain for very long period. That is the past experience. It doesn't have to be right. It is just that is the statistical data that you have for last 20 years. And that's where rightly every participants, including the regulator, is actually trying to nudge the other stakeholders in terms of whether it is AMCs in terms of disclosures, whether it is retail investor in terms of reading through those. I mean, what is the churn of portfolio? What is the concentration in the portfolio? All those parameters investors should be actually looking at, particularly when he is coming in a market where he's seeing 30%, 40% CAGR returns for particular categories over last 3 years. So that's, I think it's a fair and a very, very healthy thing that the regulator or the AMFi is doing. And we also keep looking at, in our own portfolios, we keep looking at these parameters at time frame.
Our audience is predominantly the NRIs. NRIs have one concern all the time. How will the rupee to dollar equation work out? If I pour money, if I take out my dollars and put money into India, if the rupee depreciation were to happen, I stand to lose my dollar value. This is the concern, which is a genuine concern for them. As a fund manager, as head of equities, how do you see, based on the macros which are stacked up today, rupee dollar equation is headed to within the next 5 years? Will it be a massive downslide? Will there be a slow downslide? Will the rupee appreciate, stagnate here? What is your view on this? Of course, I'll not hold you responsible for this. Future is always uncertain. It's just the gut feeling I'm asking.
Here, I'll not give you gut feeling. I'll just stack up the argument and put up a logical argument, and then we'll actually come to conclusion, and that conclusion might play out or might not play out, because there is always uncertainty around the variables that you have considered or assumptions that you have considered. So actually, if you look back in the past, we always had more depreciation than appreciation. If you look at probably in 2009, the rupee was at 40, 45 rupees. Today we're at 80, 85 rupees. The reason has been very simple. The fundamental principle on which the currencies work is the interest rate differential or inflation differential. US always had an inflation, which was probably for last decade at least, as far as I remember, probably 1.5%, 1%, 0.5%, 2% max. So on an average, if you take probably anywhere between 1 to 2% was the inflation. We as a country, if you take last 10, 15 years, consistently have an inflation of about 6 to 7%. So there is a 4-5% inflation differential between our and US inflation rates that was there. That was causing the 3 to 4% or 5% depreciation that you see every year. So the depreciation happens with the currency where the inflation is higher to the proportion of differential between the interest rates or inflation, which is exactly what was happening. Now fast forward today, and when you look at next 5 years, what is happening? If you look at India's inflation, gradually as your basically friction in the economy, the supply sides are improving, the inflation is more likely to be about 5% average for next 5 years. rather than basically 7%, which we 6.5, 7% that we experienced over the last 15 years. On an average, I'm telling you, not necessarily particular year. When you look at US, because of the way they have actually exploited their credit worthiness, their debt to GDP has gone up. Their supply sides have not improved incrementally. In fact, they have given up on supply sides. So their inflation on a sustained basis is likely to be on the higher side of their own band, which is probably, my assumption is anywhere between probably 1.75 to 2.75. So if I take broadly 2.5, that's where it should be. So now if you look at the equation, the rupee, which was depreciating 4 to 5%, even statistically, just based on the inflation differential, now it will come down to probably 2% or less than that. That's one argument, which is very, very fundamental macroeconomic argument. On top of that, you add to the factors which are improving for India. So if you look at India, and typically your currency, in a way, the other thing which it is a function of is basically how your basically merchandise and current account deficit is every year. And that's where we actually launched manufacturing fund. That's the basic principle why we thought that basically manufacturing fund is likely to do, manufacturing as a theme is likely to do well over next 10, 15 years. Basically, we have predominantly three sets of things which were impacting the merchandise or current account deficit and inflation thereof, or currency thereof, inflation thereof, currency thereof. One is we import everything in terms of energy. We import 87% of the energy. Now look at energy, how the dynamics is likely to change. Probably 5 years down the line, you will have at least 10% to 15, 20%, depending on how fast it happens, energy mix change towards the renewables and EV. Okay. So one, your absolute energy import requirement is likely to not grow at the same pace, at least at which it was growing in the past. Okay. Which means you have to send lower dollars abroad. Second is gold, which I don't think is likely to change. It is very, very sticky. All of us love gold, so that is unlikely to change. And third is, on top of these two things, till probably 90s, we were manufacturing a lot of stuff, at least whatever was required. After that, we gave up on everything because suddenly in a global manufacturing supply chain, in a world which is far more driven by global supply chains, we started losing the competitiveness. And it was a combination of all the factors, whether it is government policies, whether it is scale, whether it is cost structure, whether it is infrastructure cost, whether it is logistic cost. I think gradually that has started turning again in your favor in terms of where your labor cost is, given that we will be the youngest population, our wage cost will be lower than even China's wage cost. It's already in some certain sectors because China is already a middle income country now. So they need far more labor wages than India now. Your infrastructure has improved, your ports have improved, so your logistic cost is going down. Your cost of capital is going down. Like what I said, if your inflation keeps moving down, your cost of capital will keep moving down. On top of that, you have a government which is actually creating an environment where the policies are likely to enable basically domestic manufacturing and export ecosystem creation. To aid all these things, we have this lottery that COVID has given to all the emerging markets, where finally the developed markets want to deal with the non-China emerging markets in terms of supply chains, which means you have an environment where there is a large manufacturing imports that we are doing as a part of CAD, which is likely to shift towards India. Now, why I spent so much of time on this is your energy and manufacturing paradigms are likely to significantly change over the next 5-10 years, which means your dollar requirement will go down, which means your pressure on the currency in the years when you don't get FII flows or FDI flows will go down, which also means that impact on the currency which your macroeconomic imbalances were causing in terms of energy basket or in terms of manufacturing basket will keep moderating. I'll not say in 1 year it will suddenly improve, but it will keep moderating. And at the same time, on the other side, you have US and Europe, which in my personal view, and here you shouldn't hold me for this, they have been exploiting their creditors' position just too much. They've been just borrowing and printing too much. If you keep borrowing and printing, even if you're US, at some point in time, people will say, I'm not going to lend you at 1.5% or 2%. Either you print it domestically and borrow from domestic market, which means the inflation in US has to go up and their currency has to depreciate. Or if they have to borrow from global saving pool, which is Japan, India, and everybody else, or global institutions, they have to increase the interest or they have to keep interest rates higher than their own historical level. Either which ways, it is conducive for Indian currency. So my hunch is over next 10 years, we'll see probably at the margin, if I take point to point, probably neutral to appreciation of Indian currency, unless we big time screw up something in terms of macroeconomics, rather than actually significant depreciation over next 5-10 years. Of course, a lot of these things will happen parallelly and gradually. They will not happen in one day. So you will still continue to have that interest rate differential depreciation of 1 or 2%, 3%. Clearly, first, it has come down from 5% to 1 or 2%, 3%. Second, your structural factors, both domestically and against the developed markets, will ensure that your currency is unlikely to depreciate a lot. In fact, this is a very, very different view than most of the economists. Personally, firmly believe that basically you will probably more see neutral to appreciation of currency barring next 2-3 years, 5 years, if you take a longer horizon rather than actually the depreciation that we are used to for last 30 years.
Mr. Sridatta Bhandwaldar, it has been a great talking points with you. Our audience will be excited because you are giving them a hope that the rupee is not unlikely to depreciate the way it used to depreciate in the past. Thank you very much for all these inputs. And when these inputs come from learned people like you, it's an information. It will be an informed decision for the investors when they invest in India. Thank you very much for your kindness to come on my podcast and share all these points. We remain in gratitude to you for your kindness. Thank you very much, sir.
Thank you, Mr. Bhatt, for having us on your show. It was quite an interesting interaction. Thank you.
Dear viewers, hope the conversation I had with Expert of the Week helped you to understand what exactly is happening in the stock markets at this point of time, not only in India, but across the world. If it answered you questions that could be there in your mind, like rupee dollar equation, and if it give you the answer, please give me a thumbs up. And if you are a person who is watching my channel for the first time, or if you are yet to subscribe for the channel, please hit the subscribe button and press the bell icon. Do not forget to share these videos with your near and dear ones, friends and relatives, and on all the WhatsApp groups on which you are connected with. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you with yet another topic or with yet another expert next Tuesday. Till then, stay safe. Jai Hind.
Press the bell icon for more details and subscribe our channel.